first notes that I have up here, these are from our class on last week. And I just wanted to take 2 minutes or so and go through a review of this, because we're going to be using these the rest of the semester. So we have to know these, the T account layout, the accounting equation, as well as the journal entry, 2 questions that we want to always ask ourselves. All right, so remember the equation, everything has to equal, everything over here on the asset side has to equal everything added up on the right-hand side of the equation. Take this off for a second. All right. The normal balance, we need to keep in mind the plus and minus, the 2 ends. We got plus and plus. Those are going to be the assets and the expenses, the pluses being on the debit side. And then the everything else, everything in the middle is going to have a plus on the credit side. And remember, the only thing I want you to remember about debit and credit is debit means left, the left side of the T account, and credit means the right side. And so then we just also, then we need to remember which account has the debit as the increase and which account has the debit as the decrease. And that's what remembering the middle are the same and the 2 ends are the same. And then the other thing that we need to remember for especially this week as well is the 2 questions to ask. We're going to ask ourselves for the debit question, what did the business get? And we could have more than one thing. We could easily have 2 or 3 things, maybe even more than that. But we're going to have at least one. And then, why did the business get it? Or how did the business get whatever number 1 was? And we're going to have at least one of those credits, maybe more, but at least one. Okay, let's bring that down. We're going to bring up our new notes for today. There, with adjusting entries, I have broken it down into adjusting entries are going to fall into one of 4 categories. And adjusting entries are what you do at the end of the month or the end of the year. However big your business is, you're going to do it usually at one of those times. If you're a really big business, you probably are going to do some at the end of every month. Even probably most businesses are going to do some at the end of every month. And then for sure at the end of the year to get your books all up to date. Because not everything is I need to make a transaction for that. Because whenever cash is involved, something tangible that you can touch, you know that a journal entry has to happen. Like if you get money or you pay money, you have to have a journal entry because you got to keep track of that cash and then what it's paying for or what you're getting it for. But there are sometimes some entries, especially things that happened throughout the entire year, a little bit at a time, or something that happens right at the end of the year that you may not think that, oh, I need to make a journal entry for that, because even though cash wasn't used, something still happened with the business. And so that's where one of those somethings, if it falls into one of these 4 categories, then we need to make a journal entry for it. The first thing we're going to talk about here is in quadrant 1. You're going to see down below Q1 all the way through Q4, quadrant 1. And then we're going to come over, we're going to come down here to quadrant 2. Then I'm going to come over here to quadrant 3 and then quadrant 4. The first one, quadrant 1, is the most in-depth. Just because it has the most different types of accounts that could be used. And I've put a few of the most common up here. The prepaid expenses, we're going to see that one can definitely be an adjusting entry. When you first pay for something, like a prepaid expense, something that you're going to use for the next few months, then that's the easy one. That's the one where we know we have to record. It's when that prepaid is over, well, nothing really happens. For example, like when you prepay rent for a couple months in advance, and at the end of the last month, nothing really happens. You don't pay, you begin to pay for the next month probably, but nothing really happens at the end of that month. But we need to show that our rent is now used for those months that we prepaid ahead of time. Same with supplies. Supplies we're going to purchase right away, but we're not going to necessarily use them. We're going to use them a little bit over time. Then when we do use them, then we need to expense them because we got the benefit of it. Remember, with the expenses, you've got to get the benefit of it right now, and you've got to have the benefit last less than a year. And so with supplies, when you buy them, you're not necessarily getting the benefit of it right then. You're going to get the benefit over those supplies over maybe the next 6 months. And so we need to, we're going to do some entries to show now that I've used those supplies a little bit of time, I need to expense them out. All right, so our first, with these deferred expenses, quadrant run, deferred expenses, we're going to look now at what deferred means. Deferred means basically you're paying money now. So that is our normal entry because cash is involved. We're paying something. But we're not going to get the benefit until sometime later. Like with the prepaid expenses. I'm paying for insurance now, but I'm not going to get the coverage of that insurance for until the next 6 months. So the benefit is later. Same with supplies. Depreciation is one we're going to look at in a lot of detail. Depreciation is when you use your big assets, like a vehicle. You bought a vehicle, but you don't expense the vehicle in year one because you're going to use it more than just year one. You have to expense it a little bit at a time. And so those depreciation entries are done at the end of every year. And when we come back over here, when we come over to quadrant 3 and 4, it's going to be just the opposite with the accruals. We're going to get a benefit now, or we're going to do work now, but we're not going to pay or receive money until sometime in the future. And without even knowing it, we've already done a couple of these in our first week. We've dealt with items that we were going to pay later, payable, where we got the benefit of something now, and then we're going to pay it later. But we have to record it when it happens right now. And then we have to record the cash payment later as well. Same thing here. We did our job. Accounts receivable, we're going to be receiving money. But we have to record it when it happens, when we completed our job right now. And then when we receive the money, that's at some time later. So that's what an accrual is. Okay, now we're going to get into some examples to kind of see how this works. And I'm going to also have up at the same time, and I think this will help us. I'm going to have up a T account sheet. So as we go through these, we're going to put the items into the T accounts and do the journal entries. And so I think you'll get a better visualization if you can see it actually in the T accounts as well. All right, so on December 1, we're talking about deferred expenses. So what this means is we're going to get the benefit later. That's deferred. We're going to pay right now. All right, so we're going to pay $1,000 rent. We're in December 1, and that includes for 2 months. This month in December and next month in January. So my debits come down here to prepaid rent. And I would put in here on December 1 that I had $500 on 12/1. And then I also have $500 over here in rent expense. So those are the two things I got. Rent benefit right now and rent for next month in January. And then come over here and we would have lots of different cash things going on. This is just like a snapshot of a little company. So even though it doesn't make sense that our first entry is a credit, you just got to know in the back of your head that we would have had a whole bunch of entries leading into this. So maybe, for example, our cash balance is $12,000. Just making that up. But now we show on December 1 that we made a payment, $1,000. So that was our normal entry. That's what we are used to from our first week of class so far. Now the new part comes in when the end of January rolls along. When the end of December rolls along, there's nothing that we needed to do because we already expensed out December's rent. We're showing it that we're using it. We can expense it in the month that we are using it. So it's fine to go ahead and expense it in December. It's this prepaid rent from January that I don't want to expense until January because it would be unfair to December or that in that previous year. Let's say this was in 2019. I don't want to put that expense in 2019 because that expense was really for 2020, January 2020. So now when January 2020 comes along, I need to show that I'm actually getting rid of that prepaid. It's no longer prepaid anymore. It's now ready to be expensed out. So when January 2020 comes along, you got to ask yourself, what did you get? Well, I got the benefit of rent. So I'm going to come to my rent expense, and this would be, as we'll see in next class session, this will actually be closed out. All of your revenues and expenses go to zero at the end of the year. And they all get funneled into that retained earnings account that we briefly looked at back in week 1 when we did the statement of retained earnings. All of your revenue and expenses get funneled into that owner's equity account or stockholders equity in retained earnings. Well, so actually this would be zeroed out, and then on January 31, we would have another 500 here, a new 500. And then you ask yourself, where did that 500 expense come from? You got to be careful. You don't want to say cash because the cash was already recorded. That 500 was included up here back in December. Where it came from was our prepaid rent. We no longer have prepaid any longer. Our prepaid account would be zero once the end of January comes along. So that is our first example of an adjusting entry. It's an adjusting entry because A, it doesn't involve cash, and B, nothing really happened on January 31 that made me say, oh, I need to make a transaction. We've got to remember to do it. That's what makes these a little bit more difficult, is we got to remember to do them because nothing actually transpired at the end of that month to alert our attention to it. All right, let's come down to another example in our quadrant 1 with the supplies. So the first thing that happened back in July of 2019, we'll say, or you can say it for 2020. In 2020, July, we bought supplies worth $700, and we paid for them. So this should be pretty simple. What did we get? We got supplies. That's our debit. And then how did I get it? Well, like a lot of things, how we get them, we get it through cash payment. So I'm giving out cash in exchange for supplies. Now, I didn't expense those supplies because I'm not using them right now. I just bought them. It's like buying maybe 4 packs of printer ink. When you get back to your store, you may start using one, and then by the end of the 6 months, you may have used most of them. That's when you're going to go ahead and make the adjusting entry once you've used them and right before you buy new stuff. Now I come down, and so that was in July. Now on December 31, I need to update my books. I need to go back and see, I bought 700 of supplies, but how much do I actually have left? And I go into the supply closet and I see, oh, I still got 1 printer ink cartridge left, or 1 printer toner, or whatever it is. And that one is valued at $150. So that's all I have left is $150 of supplies. So I know when I come down here and I make my final balance of 150, and remember how we would put a solid line to show our total. So my balance is 150. I need to think then, I had 700. How much did I get rid of to get me down to 150? How much of supplies did I use? And that's the amount that goes here. And just by doing simple math, probably do it in your head, I used $550 of supplies. All right, so then I asked myself, what did I get? I got the benefit of supplies. Remember, when we get the benefit of something, it's automatically going to be an expense. So let's just change the name of this first one because we're not going to have this yet. We'll call this our supply expense. We got the benefit of supplies on 12 over the last 6 months. We'll call it 1231. And we got $550 of supplies. And then I've already done the credit, but where did those supplies come from? It came from my pre-existing account, my inventory, or not my inventory, but like my inventory little stash in my closet. So that would be our adjusting entry to show that we got the benefit of supplies. And it came from our supply account. I didn't pay cash again for it. I already paid for that back in July. Now I'm just using the supplies. All right, our last example in this quadrant 1 is using our big assets. And when we use them, we call it depreciation. Now we got a couple terms to look at. So whenever we buy something big, something I'm going to use over many years, we have to expense it a little bit at a time. And the most common way to expense an asset is what's called the straight line method, where we do it the same every year, the same amount. And that is the most easiest, and it's the easiest, and it's probably one of the most accurate, because when you do buy an item, you probably do use it very similar amounts every year. And so you should expense it the same every year. So a couple things that we need to know when we look at depreciation. First is we need to know what the item's useful life is. How long do I, as the business, expect to use that asset? It's not how long will the asset actually work. It may work for 10 years, but I only expect to use it for 5 in my business. Then I'm going to sell it and then buy the newest thing. So I need to know what the useful life is for me, which would have been 5 years, not the 10. And then the other thing here is the type of depreciation we're going to use. Until much later in the semester, we're going to deal with straight line. That's just kind of the default method to use. And it's simple to do to get the same amount every year. All you need to do is just take what did the asset cost you to purchase and divide it by the useful life. How long do you think you're going to use it? And then you just spread out that cost a little bit every year. And we put it on over into depreciation expense. The other new account that we're going to use is this accumulated depreciation. Accumulated depreciation is going to help us determine the book value of our equipment. And it's going to be another term that we're going to see here in a few minutes when we actually get into this this entry. The accumulated depreciation keeps track of your total amount that you've expensed every year. It keeps track of that every year. Whereas you think, oh, well, isn't what the depreciation expense do? Doesn't it keep track of your expenses? Yes, but, and we're kind of getting ahead of ourselves, but that's where I had mentioned just a few minutes ago, all of our expense accounts, they go to 0 at the end of the year. They get funneled into retained earnings. So when we start next year, our depreciation expense is right back to 0. It's not keeping track year to year to year. It's only showing me this 1 year for the expenses. The accumulated depreciation, it doesn't go to 0. It's like the equipment, it stays, it keeps its balance year after year. And so we can keep track of how much I've depreciated out of the whole total. That's what its purpose is to tell us. So let's think now we're January 1, 2020, and I bought a piece of equipment to use in my business, for $15,000. Useful life I've determined is I'm going to use it for probably 5 years. So I asked myself, what did I get? And it's easy. We've got equipment. So we put it at 15 grand here. And then how did I get the equipment? told us in the problem that I paid cash, $15,000. So that would have been my credit. Now, notice here, there is no account called equipment expense because I'm not using the equipment all this year. I'm using it a little bit over the next 5 years. So now to get the depreciation expense, all we do is go back up to this formula, put in the cost, 15 grand. It's the cost of the asset. So if you need to, put it in your calculator. So if I put in 15 grand and then divide by the useful life, 5 years, that tells me basically I'm getting the benefit of $3,000 every year for 5 years. So that's what I want to expense, is that partial value that I'm getting right now. So when I come down to December 31, my adjusting entry is going to show that, okay, I got the benefit of the expense. I come down here to 12/31, the end of the first year, 2020, put in 3,000. I got the benefit of my equipment. And then I come back over to my equipment account, and this is what is called a contra account. Contra accounts I have on our sheets as red accounts because they're backwards. Contra means backwards in accounting. And when it's contra, that means plus minus is flipped. So every other account in the assets has plus over here. And then when we get rid of something, we subtract it with a credit as a minus. This is just the opposite. It's contra. So this is our minus account over here. And this is our plus. It's backwards. What that means is, and there's a reason why it's a contra account, is when we put this over here as a $3,000 credit, it's contra, so this is minus now. This debit column here is minus. This is plus for this account only. When I go through and I'm ready to add up all of my assets to see what my total assets are for the whole year, I then use the total assets as my base. And I say, okay, everything on the left is a plus and everything on the right is a minus, even if it is contra. So when I go through and add everything up, yes, this account is positive, but that's just off on its own little island that it's positive. Mixed in with the entire whole of the assets, it's really still a negative. So if I would combine these two, I have a value left of $12,000 because this 3,000, even though it's a positive out here on its own, in the whole scheme of things, it's still a negative. So the book value is that $12,000. It's how much do I still have left that I can depreciate. I've depreciated 1 year. I've still got 4 years left of 3,000 each that I can depreciate. So that's how I get the book value. How much is left that I can expense or depreciate? One thing that a lot of people get confused on, they think book value means that's what it's worth, and that is not the case. Book value is simply how much can I still depreciate. That's it. This vehicle could be worth $12,000. It may be worth less. It could be worth more. We don't know. That is not what book value tells us. Book value is just between what you and a buyer or seller would agree to. That's all. That's what fair market value is. That's what maybe the Kelley Blue Book does. It helps you determine what the fair market value is. This is not the fair market value. Now, so we've done it for 1 year now. We found the book value. Book value is $12,000. Now, when I go on to the second year, so I'm now at December 31, 2021, year 2. My entry, as you'll see, looks exactly the same as the previous entry. Same item, same accounts, same amount, because it's the same every year. I'm using 3,000 every single year. So if I come over here to my depreciation expense, this would have been zeroed out. This would have been 2020 in 2020. Now I'm down here in 2021. This is 0. And I put in a new $3,000 for year 2021. I come over here, this guy isn't zeroed out. So I got the end of the month, December 31, 2021. I've put in another 3,000. So when I add these up for the end of 2021, I'm at 6,000 now. Total depreciation. And this word tells me that it is the accumulated. And that's what this account does. It accumulates all of your past depreciations. So now my book value is now the original cost minus how much I have totally depreciated over its entire life. I've depreciated 6,000. So its book value is now 9. That's how much I have left to depreciate, 9,000 over the next 3 years. All right, so quadrant 1 has the most accounts. It's the most, maybe complex, just because it has the most. Now we're going to go a little more quickly with the other 3 quadrants. So quadrant 2, go back up to my little plus sign. Quadrant 1, we talked about deferred expenses. Quadrant 2, we're just going to jump down and talk about deferred revenue, just the opposite. So here, we paid for something up front, and then we're going to get the benefit later. Here it's just the opposite, because we're talking about revenues. Our customer is going to pay us up front, and then we're going to give them the benefit at some time later. So the best way to think of this account, unearned revenue is a liability. So when you look at the T accounts here under the liabilities, unearned revenue is something besides cash that I owe to one of my clients. Most of liabilities are cash. This one is one of the odd ones that it's not cash. I actually still owe them a service. Think of unearned revenue. The best way to think of this is gift cards. When you go to Texas Roadhouse and maybe for Christmas you buy a gift card, you've given Texas Roadhouse money. They need to account for that money that just came in, but they can't count it as revenue because they haven't done anything to earn that money. It's going to be later when they actually provide somebody a meal that they can go ahead and count that as revenue. And now they don't owe you any service anymore. So that's what we're going to do in this quadrant 2 with deferred revenues. All right, so back to my business. I'm in the snow removal business, and I got paid $900 to remove this business's snow for the whole year. Regardless if it snows 3 times or if it snows 10 times, I get paid a set amount. And then I need to show that I'm earning that revenue, whether I actually do work or not, because we have determined that our shoveling season is from December through the end of February. Now, could we have a little bit in November? Yep. Could we have a little bit in March? Yep. Sure, we could to shovel. But our main shoveling season are those 3 months. And so that's how I'm going to divvy out my revenue. So what I do is on December 1st, my client pays me and says, okay, here's $900. I want to get in your schedule for the rest of the year for the snow season. Sure. All right. So we got to do our normal entry. We got to ask ourselves, what did I get? I got cash. So on December 1, I would show that I got $900 money. And then I can't come over to revenue because remember with revenue is you got to meet 2 criteria. You got paid or promised to be paid. We did do that. We did get paid. And the second criteria is the job's done. Job's not done. So I've got to come down to show that I owe somebody a job. I owe them on December 1, $900 of a job that I'm going to do equally over the next 3 months. So on December 1, that would be our journal entry. Now comes the end of the year, December 31. It's now time to make adjusting entries. Nothing happened on December 31, or they didn't pay me any more money on December 31, but maybe I've actually shoveled some snow. Maybe I haven't. It doesn't really matter. On December 31, I've still generated 1/3 of that $900. 1/3 of it is $300. So I asked myself on December 31, what did I get? I actually got a reduction. Remember, for liabilities, the debit is a minus. I got a reduction on what I owe. I owed $900 in service. I got a reduction on that because 1 month has now expired. And then we ask ourselves, okay, what did we get? We got a reduction on what we owe. Why? It's because I did my job. My job is shoveling snow, and on 12/31, I have now earned 300 of that 900. Whether I did it 1 time or 5 times doesn't really matter, because I'm breaking it up equally each month. So I've earned $300 by the end of December. Same thing would go with a gift card. Texas Roadhouse gets $900 for a gift card. They call it unearned revenue. And then at the end of December, 300 of those gift card dollars were used and food was provided. They would count that then as revenue. All right, so that's quadrant 2. Quadrant 3. Now we're looking at the opposite of a deferral. A deferral is money now, benefit later. We're deferring the benefit. The accrual is just the opposite. The benefit comes now, payment is later. Payment, either we are paying it or our customer is paying us. Either way, it's the same. The primary one that we're going to look at is wages payable. This is where your workers have worked during maybe that last week of December, but you're not paying them until January. It would be unfair to January to count all the work that was done in December on January's books. We don't want to do that. We want to put December's work with December's books, even if cash isn't paid. So when we come down here to our quadrant 3, this is where when we have an adjusting entry, most of the time adjusting entries come second. Work is done later, and we're going to do like depreciation at the end of the month or the end of the year. Well, this one's just the opposite. The adjusting entry comes first. We got to show that work was done right now. So here's my little scenario. Our people are paid semi-monthly, so that means twice a month. And they work here December 15th through the 31st, and then they are paid $2,500. Pay as of, if they were to be paid on December 31, they would have gotten $2,000. That's how much they'd earned. And then maybe we give them 1 extra day, a holiday pay, we give them a $500 bonus. So that's why they're paid $500, an extra $500 in January. But that's for January, that's for the holiday. So what I want to do is I need to make an entry at the end of December to show that work was done in December. The work that was done, I need to show that just the amount, not the total amount that's going to be paid, because some of that involves January, and I don't want to include that. I want to include just December. So I'm going to come down here and say, okay, work was done. I got the benefit of my workers working. So on 12/31, I got $2,000 worth of benefit provided to me, me as the employer. And why did I get work done? Well, usually it's because I paid money to my people, but this time I'm going to pay them, but just later, next year. But so at the end of this year, I don't want to show that cash was paid because it wasn't. That would make my books wrong. So I'm going to show that I actually owe money. I owe $2,000 as of right now, December 31. $2,000 that I'm going to pay within that first week of January next year. Now, comes January, and instead of paying just $2,000, I actually pay them a tiny bit more. I pay them $2,500. So this is one of the harder ones to think about with what did I get versus how did I get it. When I pay them $2,500, what am I getting? Well, the biggest thing that I'm getting is a reduction on what I owe. I no longer owe them $2,000 anymore. I'm getting a $2,000 reduction. Now I don't want to put $2,500 here because that would make this a negative amount. If I put $2,500 here, then I would have a $500 negative balance. I don't want to do that. I never want my balances to be negative. So this zeroes out. Now I know that I paid a little bit more than $2,000. So what else did I get? Well, I got the benefit in the next year. So this would be zeroed out at the end of December. On 1-6, I got the benefit of an extra $500 in the current month in January for more work, or what if it's a bonus or whatever, but I'm still paying my workers. So they get a $500 extra expense for the new year. Now, why did I get a reduction on my wages payable? And why did I expense $500 more? Well, that was because I paid my workers. So on 1-6, I come over here and credit my cash because I actually wrote them a check for the amount of money that they earned. The total of all the checks was $2,500. All right, our last one. Perform services. Valued at $1,500. This we've already done. It may seem like we've done adjusting entries, and the answer is yes. We've already done examples just like this in last week in our journal entries, but we're going to look at it here again just to reaffirm it. Perform services valued at $1,500. They're done, and our client says they'll be able to pay us on January 10th next year. I don't want to put that revenue and hold it off until next year when I get paid. I want to show that I got the revenue right now. I want my books to show an increase in revenue for this current year. I want it to look better, and I want it to reflect the work that I did. So what I do is I ask myself, what did I get? And as of 12/28, I got a promise to be paid for $1,500. My client owes me $1,500. Then you ask yourself, why does my client owe me $1,500? Well, they owe it to me because I did my job. 12/28, I did work, and I earned $1,500. And I do meet the two criteria. I either A, got paid, or got a promise to be paid. Yep, I got a promise to be paid. And B, the second thing is the job's done. Yep, it's done as of 12/28. Now, come December 10th, when the check comes in the mail, I ask myself, what did I get? And on January 10th, I got money. And then you ask yourself, and this one can be a little tricky, you think, why did I get the money? Oh, it's because I did the job. Yes, true, but I already accounted that. I already counted that I did the job back in December. I got the money because my client owed me the money. Now, as of 1-10, my client is paid it off, and they now owe me $0. Their bill is $0. So those are some examples of some adjusting entries. We're going to, we're not going to do the correcting entries. And so at this point, we are ready to do the final trial balance. Once we've done all the adjusting entries, we're ready to do what's called the adjusted trial balance. Think of that as your final trial balance, the one that you're ready to do all of your financial statements off of. This is that last step before you do the financials. And remember the whole purpose of doing a trial balance. There are two reasons why we do it. One is to summarize all of our T accounts and to put them in their correct order. So adding up all of the cash and to have one final number and then showing what that amount is. And then showing that all of our debits, when we add them all up, and all of our credits, when we add all of those up, our final balances, that they equal. That's the whole purpose we do a trial balance. So now, what we've done so far, and what we can add in as our, that we did back in day one, we've done last week, we did the journal entries in the T accounts. Now we've just looked at the adjusting entries, and now it's time to prepare the adjusted trial balance. And then once we do the adjusted trial balance, we're ready to go in and do the financial statements, the income statement, statement of retained earnings, and the balance sheet.